Q3FY23 earnings conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Agarwal from Axis Capital. Thank you, and over to you, sir.
Thank you, Lizanne. Good morning, everyone, and welcome to this earnings call. We have with us Mr. Y. Vishwanath Gowd, MD and CEO, Mr. Ashwani Ghai, Chief Operating Officer, and Mr. Sudipto, CFO. I would request Mr. Gowd to share his initial remarks on the results, post which we'll open the floor for Q&A. Over to you, Mr. Gowd.
Okay. Thank you, Praveen. Thank you. Very good morning to all of you. I extend a hearty welcome to every one of you to the post-earnings conference call of LIC Housing Finance Limited. As you are aware, LIC HFL declared its Q3FY23 results yesterday. Prior to detailing the operational aspects, I would like to highlight that the current fiscal year, RBI had increased the repo rate by 225 basis points in 5 consecutive MPC meetings, in line with the monetary policy tightening across the world due to inflationary pressure. Consequently, the company also raised its LHPLR by 210 basis points in the current fiscal year till date. The financial highlights of this quarter as follows. Total revenue from operations 5,871 crores as against 5,054 crores for the corresponding quarter of the previous year, showing a growth of 16%. Outstanding loan portfolio stood at 2,68,444 crores as against 243,412 crores as on 31st December 2021, reflecting a growth of 10%. Out of which, the individual home loan portfolio reported a growth of 14%, and now it is comprising of 83% of total portfolio. It is up from 80% 1 year ago. Then the total disbursements for the quarter was 16,100 crore as against 17,770 crore for Q3 of FY22. Out of that, disbursements in the individual home loans were 13,580 crore as against 15,341 crore for Q3 of FY22, whereas the project loans were 427 crore as compared to 293 crore for the same quarter in previous year. It is up by 46%. On the net interest income front, the NII was 1,606 crore for the quarter as against 1,455 crore for Q3 of FY22 with a growth of 10%. The net interest margin for this quarter has been stable at 2.42% as against 2.42 for Q3 of FY22. Profit before tax for the quarter stood at 593.01 crore as against 961.85 crore, a decline of 38%. Profit after tax for the quarter stood at 480.30 crore as against 767.33 crore for the same period previous year with a decline of 37%. In terms of asset quality, Stage 3 exposure at default stood at 4.75% as against 5.04% as on 31st December 2021 and 4.9% as at the end of September 2022. This quarter, our focus was on margin improvement and asset quality. As you would note, there is an increase quarter after quarter in NIMs from 1.8% to 2.42%, bringing us back to the Q3 of FY22 levels. This has come on the back of better liability management and passing on the increase of PLR by 115 basis points in Q2, which has taken effect from Q3. A further 35 basis points hike was effected in December 22, which is effective from January 1st of this quarter. The other focus area was on asset quality, wherein we have seen stable numbers with a small quarter-over-quarter decline, the asset quality trend is looking positive and improving. We are very much positive on that. You would note that this quarter we have made higher provisioning to the tune of over 760 crores. This has been made to increase the overall PCR substantially. The stage 3 PCR now stands at 50.8%. It is up from 43.6% one quarter back and significantly higher than the December 21, where it stood at around 39.7%. It is in line with the company's objective of strengthening the balance sheet. Last few months, there have been successive repo rate hikes by the RBI, due to which the home loan rates have also increased across the industry. Though this has a slight impact in slowing incremental business, our individual home loan book continued to show growth of 14%, by and large in line with our expectation. The disbursement for the 9-month period registered a growth of 13% overall and also 13% in the retail category. On the funding side, we have witnessed an increase in the cost of funds, which stood at 7.4% as compared to 7.1% in Q2 of FY23 and 6.69% as on Q3 of FY22. It is attributable mainly to a total cumulative repo rate hike of 225 basis points by RBI in the current fiscal and increase in other benchmark rates like T-bills and G-Sec, etc. Incremental cost of funds also inched up and it stood at 7.61% for Q3 of FY23. The further interest rate trajectory will be largely governed by the ensuing RBI rate policy. With this brief introduction, I would like to invite you for your queries. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Hello. So my first question is on the provisioning figure. Does that include any write-off or it's all provisions only? Hello.
Members of the management team. Hello. Members of the management team, are you able to hear us? Ladies and gentlemen, we seem to have lost the audio from the management's line. Please stay connected while we try to regain the audio.
Is it okay now? We're correct now?
Hello.
Yes, sir. Are you able to hear us?
Yes.
Yeah, we are online only.
Okay, sir. So please proceed.
Yes, madam. I think we answered her. No, we told that there is no write-off.
I'm so sorry, sir. We were unable to hear you all.
No, there are no write-offs, Mahrukh.
Okay. And just in terms of your gross state, was there any slippage from restructured loans this quarter?
No, the restructured slippage, as we mentioned earlier also, it is in line with around 15% which has been there. So that is consistent for the last 3 or 4 quarters.
Okay.
But overall, there has been a reduction. Slight reduction is there overall.
In the restructured slippage
QoQ? Yes.
Okay. Thanks. Thank you.
Thank you, ma'am.
Thank you. We'll move on to the next question. That is on the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes. Good morning, everyone, and thank you for taking my question. So, again, coming back to this credit cost that we took during the quarter, just wanted to understand, during your opening remarks, you had suggested that this was in line with the company's objective of increasing the strength of the balance sheet. So, just trying to understand this a little better, from what we've known all along is that the provisioning is usually driven by an ECL model, So, I mean, has there been a significant increase in the risk that we foresee that has led to an increase in PCR by about 7 percentage points on a sequential basis? Or let's say you are anticipating higher slippages from the structured pool over the next 6 months when those moratoriums in your corporate book get over. So that's my first question.
Okay. One thing here I would like to say that ECL and all, okay, we're having a policy, we follow it. And here what happened, as I mentioned also, to strengthen the balance sheet, one thing. And actually the management overlay, what happened even other day also, we actually, even last time also we were telling you what happened, the PCR ratio, we would like to actually bring it up compared to earlier years. Now it is around more than 50%. That is the only intention. With that we have increased our provisioning, and then PCR is now it is in line with the industry now.
Got it, sir. So at least can we take that comfort that now that you've increased it to, let's say, 51%, you're
Right.
going to maintain at these levels, and we will not see the kind of volatility in stage 3
Yes.
provisioning coverage ratio?
Sure.
All right.
This will be maintained, yeah.
All right. So the second question I had was on prepayments. I mean, at least your slide 11 of the presentation says that the prepayment rate was about 9.3% for the 9 months, which I would say is significantly lower than about 10.5 to 11% that we've seen in the past. So has there, what you also said in the last quarter, has there been significant outreach in terms of retaining customers, giving out certain incentives to them to retain customers, which has kind of led to a lower prepayment number in this 9 months?
No, as far as the incentive, etc., there was no incentive or anything of this sort in this quarter. But overall, the prepayment rates have come down because of probably a tightening liquidity outside.
Okay, one more thing, market also what happened now, rates are increasing, no, in the sense
Yes.
increasing scenario, switchovers normally will not be that much in the market.
Come down.
Naturally they show a downward trend.
Got it, sir. Sir, I have one last data keeping question. If you can just spell out for the benefit of all of us the restructured book which is outstanding as on December 22, the third quarter, and if you could also split that into corporate and retail, and also tell us when will the moratoriums get over, and typically what you share in the earnings call, a split of your stage 3, this is the 4 product segments.
Okay, figures will give it to you. Yes.
OTR you wanted? OTR for December outstanding is 1,420 crores, out of which the project is around 250 crores and the retail is 1,169 crores.
Okay. And so when will moratoriums get over in this 1,420 crores?
I'll share with you the timeline. 600 crores will come out in the month of March. And again, another 600 will come out in the next quarter. And the residual will be in the last quarter, September, which is just a few hundred crores.
Got it. And so then the split of stage 3, this is the 4 product segments?
In the stage 3, as far as the categories are concerned, the IHL stage 3, this is all in days, right? So it is 1.62. For the non-housing individual, it is 6.74. For the non-housing corporate, it's 22.5. So the total retail is now 2.99 and the project is 45.6.
So this is useful, sir. And just one last question, sir.
Overall is 4.75.
4.75. Got it, sir. And sir, one last thing here. In your presentation, you spell out what is the provisions that we are maintaining on those IREC NPAs, basically things which are NPA as per RBI circular but are classified under stage 1 and stage 2. So if you could also give what is the quantum or the pool on which you have maintained these provisions of about 110 crores.
I have it offhand, but I'll give it to you.
All right, sir. Thank you so much, and all the very best to you and your team. Thank you.
Thank you, Abhijit.
Thank you. The next question is from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Sir, thank you. My question was on the NPA coverage, which you just mentioned. In terms of loan to value of the NPAs, how much would you have? In the sense, is the disposable value, will that 50% coverage take adequate care of it going forward? Or how do you see it going forward in terms of resolution? That's my only question, sir. Thank you.
Yes, that is there.
See, so Vivek, can you just repeat the last part of your question?
Sir, what I wanted to know was you increased the provision coverage to 50%. Now is there enough to start resolving this NPL?
We got your query. Yes. As far as the LTV is concerned, I will take you to some of the disclosures made in our presentation. You will find that the LTV at the time of giving the loan itself is around 45 or around 50%.
Within that.
Within that. So that does not take into account the repayments which happen on that account and any improvement in the property prices. So after the assumed haircut or the presumed haircut, there is substantial headroom available for full recovery of principal.
Correct. That's correct.
Sir, thank you very much and good luck, sir.
Thank you. Thank you.
Thank you.
Thank you. The next question is from the line of Umang Shah from Kotak Mutual Fund. Please go ahead. Umang, your line is unmuted. Please go ahead. Mr. Umang Shah, your line is in the talk mode. Please go ahead. As there's no response from the current participant, we'll move on to the next. That is on the line of Nischint from Kotak. Please go ahead.
Yeah. Thanks for taking my question. Just 2 points. One is, again on the large provisions that you made this quarter. Is it something which is on any specific assets, or is it something that you would have increased coverage at a similar ratio across all these loans?
No, it is not against any one specific, not like that. It is our general, what you call, philosophy of maintaining very good PCR. To be in line with the industry, we increased across all.
Because in the past, I think you had guided for, around 50 odd sort of basis points of credit cost. And, suddenly it went up this quarter. So is it something that, you would want to kind of accelerate to a particular level, and then take a pause? Why is it that, you could have done it? I mean, you could have probably staggered it maybe over a 3-quarter period or something. So, just trying to understand, what was suddenly the reason to do it in this quarter?
As far as the credit card is concerned, yes, that will be maintained at the same level in the sense what happened and whatever even earlier also I indicated to you, that it will be around 40 basis points. That's all correct? Within that range mostly. 45 to 50 basis points mostly.
Yeah, but this quarter was a higher number, right? So
this was a higher number. Going forward, what is mentioned is that going forward, once we have achieved a by and large stable level of PCR,
provisioning.
By and large, after that, it will be in that range. This was with a specific, if you see the actual provisioning required for the purpose of just maintaining the earlier ratio at 42, just 1 quarter back, it was around 44%. So if we had to maintain it at around 44%, the provisioning required would have translated to a 45 basis point credit cost. But there is a specific objective to increase the PCR beyond that level. So from 43 or 44% PCR, which was there earlier, it has now moved to upside of 50%. So the balance 6 or 6.5%, which has been created as an additional provisioning cover, that has led to the increase in the overall credit cost. But if you just break down the numbers and see how much of credit cost would have translated if we had maintained the earlier PCR, then it would have translated to that same 45 basis points. Please keep in mind that there has been no increase in NPLs.
Yes, NPS in fact is slightly reduced over last quarter. Small reduction.
That's true. On the disbursement side, in the individual segment, we have seen some decline. I think on a year-on-year basis, it's closer to around 10%, 11%. So how should we kind of think of it? Is it something that the best phase in terms of real estate growth is behind us, or is it just a base effect? And what kind of a growth would you really see in individual disbursements going forward?
Actually, in the Q3, what happened initial month of this October and November, there are small here and there some sort of reduction was there in some region. That's why we could not score well in those 2 months. But December month gave good fillip also. With that, it was almost all brought up a good state. So what happened now, that reduction also what happened because rate hikes also were there. Probably some temporary setbacks were there. Apart from that, because of this now, in the Q4 normally, in entire what you call now across all regions, lot of what you call now momentum will be there and traction will be seen across all the regions at the highest speed. So with that, what happened? We're very sure that this Q4 will be the far better, and we are still what you call now very positive on our Q4 performance, and we will show more than I think 12 to 13% growth will be there in our volumes of disbursement in the quarter.
On a year-on-year basis, what you say?
Yes, year-on-year basis also the 13% will be maintained. That we're highly positive about that.
Because the base itself for fourth quarter is very high, so.
Yeah, already what happened because things are going on very well, and then good demand is there. Even the recent budget announcements, everything put in place, a very good what we call fillip for all these things.
Sure, got it. Thank you very much.
Thank you.
Thank you. The next question is from the line of Dhaval from DSP. Please go ahead.
Yeah, sir. Just one question relating to the credit cost. So Sudipta, you mentioned that a large part of the credit cost went into achieving a particular target provision coverage. Have we completed that journey, or still there is few percentage points of coverage increase expected post which it should normalize? If you could just clarify that part. Thanks.
By and large, now we are almost all nearing to that. Correct. It's almost all what we do thought actually 51 more than 50% we wanted to keep that PCR to be what we call now to have very good even to be in line with the industry. That's the main thing. That's why we provide for that. I think now as things stand now, I think we don't see any further increase required maybe in this one.
So sir, from 4Q23 onwards, should we go back to the 40 to 50 basis point credit cost zone? Is that fairly clear, or is there any other one-off or any such element that will come in the fourth quarter?
Yeah, as MD sir mentioned, it is now normalized.
Got it. Thanks.
Thank you. The next question is from the line of Bhavik Dave from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. Good afternoon, sir. My question was very similar to the previous participant. Just to clarify again, the provisioning that we set up on stage 1 and stage 2 is also adequate of what we think for the future, right? Like 5 basis point for stage 1 and 6.4% that we have for stage 2. The number should be in that range. We don't intend to increase that materially and keep the stage 3 provisioning at around 51, like above 50%. Is that the way to think about it?
By and large, it will be there like that.
All right. And second question is on your employee front, is there anything that is pending in the sense of wage provision or any cost that can come up in terms of employee expense that can surprise on the higher side?
No. As it is, nothing. It is what happened normally. Last year probably would have seen that once in a 4 year period. But now we are making it provision for every quarter so that it is normalized now. No one-off things will be there.
Understood. And last question is, sir, a very small observation in the sense that commercial paper borrowing for the quarter has increased on a quarter-on-quarter basis. I understand that we used to be at 4.5% even pre-COVID. This time around we've increased it considering the kind of rates that are in the offerings in the shorter end. What led to for us to increase shorter end borrowings wherein the cost is 150-200 basis point higher? Just a thought there.
See, actually, as far as the overall CP exposure is concerned, I think it is one of the lowest across all NBFCs and HFCs.
Yes.
We time it depending upon the kind of liquidity requirement and also keeping in mind the kind of interest rate view that we hold.
Sure. Understood. And last question is, what will be our incremental spreads on home?
Sir, when you're not speaking on the call, we would request you to mute your line. It's causing a lot of disturbance. Yes,
Yeah, I'm trying to understand what will be your incremental spreads on home loans.
The incremental spreads on home loans will be around 120-25 basis points.
Sure. Thank you.
Thank you. The next question is from the line of Harshvardhan Agarwal from IDFC AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. So just wanted to understand that our restructured book has come up by around 6,000 crores or 6,200 crores in the last 9 months. So how much of that has actually slipped into stage 3?
Around 15%.
Okay, so 15% is of that 6,200 crore ka number.
Yeah.
Okay, and the remaining book that has been graduated to stage 1 or it still remains in stage 2?
No, most of it is in stage 1.
Okay, got it. Sure. Thanks a lot, sir.
Thank you. The next question is from the line of Shweta Daftardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. A couple of questions. Did you mention...
Shweta, ma'am, your audio is not clear.
Is it better now?
Ma'am, it's sounding very soft and muffled.
Yeah, I'll try to be a little louder. So I just wanted, incremental cost of funds and yields for the Q3 quarter.
Incremental
cost of fund is 7.61 for the third quarter. Q3.
Yeah, Q3 7.
Yes. And so yields?
Hello.
Pardon, ma'am?
Hello. So how about incremental yields?
Incremental yield.
Yes.
Yeah, incremental yield is approximately slightly more than around 9%. Slightly more than 9%.
Okay, noted, sir. So one last question. Have you seen balance transfer outsources this particular quarter? How has been the competitive landscape? Thank you.
Balance transfers have come down significantly. It has come down significantly.
Same thing may continue also.
Sure, noted, sir. Thank you.
Thank you. The next question is from the line of Manish Jain from Value First Digital Media Private Limited. Please go ahead.
Yeah, good afternoon, sir. I'm an individual retail investor, so my company name happens to be there. That's a different thing. So my question is that although there's one good part about this quarter's result is that last quarter we saw a significant dip in interest income, so that has recovered. So last year that was a big hit. But as a retail investor, my question is that...
Mr. Jain, sir, your voice is sounding very muffled.
Okay, is it okay now?
Yeah, fine. Okay.
Okay, so as a retail investor, my question is that a year back, Q3 results were very good. We had profit of 767 crores back and EPS of about 15 rupees. But after that, every quarter something or other happens and then we don't get a good result. Like last quarter, interest income was low. This quarter, impairment is high. So now this particular impairment, I was just doing my calculation that half the PBT, more than half the PBT goes in impairment. While I was checking some other housing finance company, much lower. Okay, I'm talking of a public sector housing finance company. I don't want to name. So they have an interest income and their provisioning or impairment is less than 1% of their interest income. While in your case, it is 12 to 13% of your interest income. You have interest income of 5,800 crore and 750 odd crore is provision and impairment. It completely spoils the bottom line. So my question is, when do we see a consistent 15 to 16 rupees EPS quarter after quarter? I think every quarter something happens which spoils the results. Are we going to see same impairment in Q4 also? The 700 crore, 800 crore is just written off. That gives a very bad name to the company and that gets reflected in your multiples, in your valuation. And valuation, I'm not even comparing with, let's say I will now take name, I'm not comparing with HDFC or some private companies. Even you see Canfin Home, the valuations are much better. So what is inherently wrong with our company? I'm a long-term investor in this company, so I would like to know what is inherently wrong that we are not able to manage our assets well, and the provisioning is always very high.
No, what exactly is the query?
Now, one thing actually, what you are telling.
Yeah, my query is very clear that why we have high provisioning compared to other housing finance companies. It is same industry.
I agree. In earlier parts of what happened, the provisioning ratio, what we want to have on our, what you call the NPA, so that was not on the higher side in the sense it is not at a level where the industry levels are required. That's why this quarter we had to make extra provision only to come up to the level, number one. Number two, last 3 years, 1 or 2 quarters, what happened? Of course, last quarter income levels were less because what happened, the transmission also was taking time. And the RBI rates also were increasing. And we have got, as per our policy, what happened now, we pass on the rate hikes at the end of the quarter. In the sense, the effect will come from the first day of the quarter. That's the thing. That's why there was some sort of inconsistency as far as income levels were concerned. Now we have come up to the industry levels of this, what we call PCR. I think going forward, probably this may not be so acute what is now it is felt. And more or less, we are inching towards our consistency now, henceforth.
So we are now, as far as Q4 is concerned, almost half the quarter is over. So can we expect that Q4 results, there will not be any hiccup, which we will not, and I mean, we'll have a result which will have 15 or 16 rupees EPS, and interest income and provision, interest income will be good and provisioning will be lower, or again we'll see something or other going wrong in our P&L account?
No, we cannot give an exact guidance of what will be the profit number for Q4. That guidance we will not be giving. But yes, if you look at it qualitatively, certainly the one-off provisioning that we had done is actually to strengthen the balance sheet. The money doesn't go out anywhere. It is just to create an additional buffer. So that is in a way lending strength to the overall balance sheet and provisioning coverage ratio, which is actually a positive move by the company.
I mean, how come higher provisioning is a positive move? There is something wrong. That's why you have to provision it.
No, not like that. What happened? No, when NPS are there, we have to come up to one level. No, the provisioning covering ratio.
I mean, over a longer period of time, it should get taken care of, no?
Correct. No, it's why it is being done now.
Thank you. We'll move on to the next question. That is from the line of Sanket Chheda from DAM Capital. Please go ahead.
Hello?
Mr. Sanket Chheda, we are not able to hear you.
Yeah, today some of the lines are not.
Mr. Sanket Chheda, as there's no response from the current participant, we'll move on to the next. That is from the line of Puneet Balhani from Nomura. Please go ahead.
Yeah. Hi, sir. 2 questions. Firstly, on the provisioning bit, you have stored up your buffers, and so since there is no write-offs and and there is also a decline in NPS, is it safe to assume that as per the ECL model, the PD and LGDs are increased? That is one. And on the second bit, even on while you have guided in going ahead, the provisions will be lower. Your stage 1 and stage 2 cover is also quite low as compared to peers. So in accordance with your model, will you be needing to shore up that in the future? And, accordingly, can we expect some credit costs on, to cover for that bit? Yeah.
No, just to clarify, there has been no write-offs and there has been no change in the PD-LGD expectation.
Okay. And on the second bit, sir, on the stage 1 and stage 2, do you expect to...
The stage 1 and stage 2 is also adequate at this point in time.
Okay. So in the future also we'll be expected to maintain these levels for stage 1 and stage 2 cover around these levels.
Overall PCR will remain by and large in the range that you have indicated. There could be realignment depending upon which bucket moves to which place.
Okay. Yeah, that's it, sir. Thank you.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, sir. Good morning. I just wanted to clarify, you said that project loans have a gross stage 3 of 45%, sir. Is that correct?
Yes.
So, sir, how many accounts are there now, and what stage of resolution would they be? It will be very helpful if you can either put out a stock exchange notification, or you can at least speak on the top 5 accounts on this call itself, sir, because that seems to be a very big number. We can just start off with the number of accounts which are there and the exposure to each without naming, if we can start. So, thanks.
Actually, we cannot take any specific names, etc. Overall number of accounts in the total project loan portfolio is around 300, roughly around 300.
And even for many of them, which are in NPA now, the resolutions are also what you call coming very well. So probably in future there will be good resolution also we are expecting.
It is in different stages of resolution. It is difficult to put out a specific timeline with dates and months because some of them are in the NCLT and various other legal matters. But one thing is clear that there has not been any further additions. Number one. Number two is that we are seeing some small resolutions coming. They may not be meaningful at this point in time in terms of the number, but certainly the trend is positive.
Right. So, and 300 is the total number of accounts and projects.
Total number of accounts.
How many are in beyond 90 plus, sir?
Stage 3 will be around 140.
70.
And
total account has so 80.
Roughly 80.
80 accounts beyond 90 plus, and how many will be 60 plus, sir?
60 plus, maybe another 20, 30.
Sure, sir. Thank you so much.
Thank you. The next question is from the line of Rikin Shah from Credit Suisse. Please go ahead.
Thank you for the opportunity. Two questions. First one, I observed that the number of employees have been declining for last 3-4 quarters. So any color if you could share there. And second one was just to confirm the 35 basis point rate hike in December, have they been passed on to the borrowers or they will be effective from 1st January only?
The employees part actually, no, what you were asking, employees, no?
Number of employees.
Yeah, employees here and there, actually some people, no, normally it happens, who are joining, no, some people may leave also. And then again, that is
But the company also has got a continuous recruitment exercise, which happens at certain periods of time, certain points of time in the year. So maybe in the next couple of quarters, you will see the improvement in numbers. So that is an ongoing process.
And it is an annual base, actually. Every year it is a normal phenomenon.
Some campus-driven recruitment happens at specific times of the year.
Already we have recruited people also.
And that as far as the, what was your other query, sorry?
The 35 basis point rate hike
has already been passed on and it is effective from 1st of January. It is not factored in the Q3 numbers. It will come in the Q4 numbers.
Okay. Thank you so much.
Thank you. The next question is from the line of Shripal Doshi from Equidus. Please go ahead.
Hello, sir. Thank you for giving me the opportunity. Just wanted to ask, what is the provision that we are carrying on the 1,400 crore of moratorium book that we have?
As far as the RBI requirement of provisioning is concerned, it is 10% of all accounts which are under OTR.
So we are carrying 140 crores.
Yes.
Okay. And I just wanted to understand how much of the original restructured book is already out of moratorium?
See, the total restructuring was 7,000, slightly more than 7,000 crores.
Approximately 3%.
7,100 crores, which was around 3% of the then portfolio. Out of that, 5,264 has already come out. Around 750 crores of loan accounts have been repaid fully, that is closed. And balance, which is yet to come out of moratorium, is 1,420.
Pending is 1,400.
And then, like, how have we adjusted the additional provisions that we were carrying on those accounts? So because now we are only having 140 crore for the existing restructured moratorium account. So how have we utilized the remaining 5,000 crore provision we were carrying, like on that book that we were carrying?
Can you please repeat? Your voice was a bit unclear.
So sir, as you said, 7,200 crore was broadly the original restructured book. So we would be carrying 720 crore of provisions on that. Broadly just going by that assumption. Now that book is down to 1,400 crore. So the provision, as you said, is down to 140 crore. How have we utilized this, 600 odd crore number?
Actually, whatever provisioning was created, that has to remain on the book for 1 year. And whatever is loan closed, that can be written back. Provision on the loan closed, that can be written back.
Closed only 700 crores, no?
Yeah.
Okay, sir. Okay. Thank you. Thank you for answering my question.
Thank you. The next question is from the line of Bajrang Bafna from Sunidhi Securities. Please go ahead.
Sir, my question pertains to, again on the provisioning side, the only issue, that we are facing while, modeling your business is we don't have any predictability that what sort of provision that you will do. Do you need to spell us very clearly that what is the, guidelines that you are following? Because, as per my understanding, last 3 quarters, if we see the stage 1, stage 2, stage 3 numbers, we are constantly seeing either a stable number in stage 3 or an improving number in the stage 1 side. Despite that, we have, gone the ECL provisioning on stage 3 from 40% to 44% last quarter, and now close to 51% on stage 3 in Q3. So what is that something, that we should be, considering for our, model building, and what sort of ROEs those are sustainable in this business? Because as per my knowledge, you will never lose 50%, in the property which is 100%, has been given as collateral. So the expected credit loss, even in stage 3 can't be 50%. So what is that number based on which you are, deriving this? Not 40% is not the right number, 50% is the right number. So some sense on that, which you could guide us clearly, we will be able to predict, your company's performance clearly in terms of provisions also, and in terms of building the ROE number right, and so forth the valuation. It is just an extension of the question which was asked by a participant some time back. So we need some predictability of your numbers, which would help us to, model the numbers better. That's all. Thank you very much, sir.
As you have very rightly identified, in a real estate business with the underlying real estate asset, there is very little chance of losing more than 50%. But during the period, you have to create some buffer, because though the realization will come, it will come with a delay, with a lag. So in the interim, if the provisioning cover is specifically retained or increased or maintained at a particular level to give comfort to the balance sheet for the interim period till the time it is realized. So one has to keep that in mind. But again, coming back to your first observation, it is correct that 50% loss after even a distress sale is very rare. That does not generally happen.
And moreover, as a prudent, sir, as a matter of prudence also, we have taken this conscious decision.
Okay, so we will, would like to hear that this 50% is an ideal. We will not go to, let's say, 60%. So that is what something that I want to, get an predictability from you, so that we can model it better, sir.
I think in a year's time, the way we have increased from 39% to 50%, that itself says that we are trying to reach a particular level which gives us adequate comfort, and it actually insulates the balance sheet from any type of losses which might happen due to delayed realization of the stressed assets.
And beyond this limit, of course, may not be that much need at this moment.
Okay, got it. Thank you, sir.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Hello, sir. So in the last 6 months, or maybe in the last quarter, so say 3 to 6 months, this quarter and the previous quarter, did we have any NCLT related recoveries, and what were the resolution rates? And is there any near-term recovery expected from NCLT?
Actually, madam, in the NCLT, I think 3 cases three cases are there in the resolution which going on.
We have received some positive orders. It is in the stage of realization or implementation, you can say.
So there was nothing resolved in the last 3 to 6 months. It's only ongoing just now.
3 orders for implementation.
Okay, and what is the resolution rate there roughly?
Resolution rate means?
As in that of your loan, how much would you have recovered, or of your outstanding, how much would you, what the order says, how much will you recover?
Ajay, you mean to say in the percentage of terms, no?
Yes,
Yeah, okay. Normally it depends on the resolution, because what happened...
the exact, it is difficult to give a number, but there is about 100 to 150 crores work which is coming, which is likely.
Got it. And on an exposure of how much?
That exposure is right now I'm not able to give you, but it's the realizable amount is around 120 to 150 crores.
See, in some cases it may be even more than, it is close to the full amount, or some may be less also, the average amount.
Different accounts, this is not one account, several accounts.
Okay, thanks.
Thank you. The next question is from the line of Chintan Shah from ICICI Securities. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. So, sir, sorry to just stretch on the provisioning part. So, considering that we have made now 50% of provisioning, and once the restructured portfolio is entirely out of restructuring and post the 1 year passage, so can we also expect any provision write back from the same, or how would we be treating those provisions?
Yeah, now I think 700 crores got closed, no? As far as
750 crores has been repaid and fully closed.
Yeah, no, I mean...
Right back, no? After.
Okay, so that is already been written back, right?
10% on that.
Okay, and so just one more part. So on the provisioning part, so now I think we can now assume already we have 50% PCR. So now probably we want to start with a clean set, and now the focus could largely be on the growth part, and no baggage of any older provisionings would come in future, right? This is what we can expect?
Yes.
Yes. As things stand now, no problem. It is online.
Sure. That's it from my end. Thank you.
Thank you. The next question is from the line of Sohail Rozani from SV Rozani. Please go ahead.
Hello. Good afternoon, sir. So I just wanted to know how is the future prospects with regard to this, because interest rate being rising since quite a while, and we don't expect any decrease in that. So are we expecting the same demand, or are we expecting a better quarter, as in 3-4 quarters we are expecting good results, or as in good demand with regard to a loan?
Yeah, loan. Actually, disbursements definitely we are very highly positive. Even in the past also in the interest rate cycles, we are doing very well. This quarter, actually already with all the things in place and good support, we are very much positive that the 13% growth will be showing in our overall, what you call, disbursements year on year. That is certain.
See, just to add to what we just shared, just few months before COVID, we were still selling home loans at around 9%. Today, despite a 225 basis point increase by Reserve Bank on the repo, we are selling at a rate which is less than the rates which was prevalent in 2019 or late 2018. And at that point in time also the book grew. It's only because the rate of interest has gone up very sharply in a very short period of time between May and December. That is around 7 months or so. That is probably what is creating some kind of a temporary dampener.
Yes. But now Q4 we are highly positive. We will again definitely crossing that our already committed 13% growth rate.
Okay, sir. Thank you so much.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. As there are no further questions, I now hand the conference over to the management for the closing comments.
Over, no? Thank you all. Really, it was a good interaction. At the end, I would like to once again thank you for your continued support. And I also assure you that the company is in a very good, consistent growth path. Thank you. Wish you all the best.
Thank you. Ladies and gentlemen, on behalf of Axis Capital, that concludes this conference call. We thank you for joining us, and even now, disconnect your lines. Thank you.